Hello, my name is Steve Bigelow with the Candlestick Forum. The market trend was easily identified as to whether it was going to reverse or continue today based upon where it was trading at the T-line area. Yesterday, we saw a bullish engulfing signal in the Dow right at the 50, almost in the oversold area, but not quite. So today, when it traded positive, there was a good indication that maybe it was reversing. However, there were things that created some doubt. Now, as we can see, by the end of the day, they brought the Dow back down to where it closed below the T-line. The doubt would have kept you from buying heavily based upon a expected confirmation of bullish sentiment. However, we needed confirmation, which was not being illustrated in the other indexes. Notice what happened on the NASDAQ. It didn't quite have a bullish engulfing signal yesterday. It opened slightly above the previous day's close. And then today it opened right at the T-line and immediately started trading lower. That would have created some suspicion that the bulls weren't taking control, that the buying in the Dow might not be the full confirmation yet until we saw what it did by the end of the day. So the fact that the NASDAQ was opening and then starting to trade lower was good evidence the bulls weren't taking over control of this market. Now, this has created some very high probability option trade factors. For example, on something like NVIDIA, in the overbought condition, when it had an evening star signal and started to trade below the T-line, that was a good area to be buying puts. Now, it looked like it was basing. The puts were producing some good profits, even if you might have covered some here. The fact that they closed below the bullish candle, the bullish harami, told you this was not a confirming signal that maybe we're getting ready for the next wave down if it breaks this level. Now, this is where we're going to be doing our training on April 23rd to say, now you might be still going short with puts, but instead of buying puts, buying put spreads where the risk is higher because we're down here in the oversold area, and the logic of the math makes a lot more sense. So join us on the 23rd. There's lots of common sense elements that we can put into option trading, just using simple trading strategies, whether it's puts and calls, put spreads, call spreads, or debit spreads and credit spreads. It's all very simple. It's not complicated. So we start from the very basics of option trading and take you up through the other strategies. But remember, because candlestick analysis is merely common sense put into graphic depictions, everything is extremely simple, even the option strategies that can be applied to different trades. So for example, if you were looking at an Apple chart, you saw strong buy signals closing above the T-line, might be the place to be buying calls. And then it breaks through the first resistance level, the 50-day moving average, probably going higher. This is probably where you want to put on spreads. Same scenario here. Sell signal, gap down, you want to be buying puts. Well, today, Apple traded much lower. You're probably wanting to put on put spreads here because you're mitigating the risk. The risk is different. Up here, when you're buying puts, you're in the overbought area. Here, where the risk is higher because you're already getting into the oversold area, this being the next likely target, it makes a lot more sense to use the math that is created by option spreads versus buying calls and puts outright. So using the trend analysis, which told us when it was time to get into some good put trades, it also tells you when to start thinking about taking profits. Now you're down here in the oversold area, and it looks like you're starting to lose steam as far as the selling. This would tell us that the first time we see a buy signal, that's when you start covering your being short on this trade. Or, as we saw in the airlines today, they were trading positive. So you've got an uptrending sector, uptrending stocks in a specific sector, but the market is still selling off. So maybe the strength or the probabilities are a little bit less. So if you're thinking going long, instead of buying calls, maybe you're buying a call spread where your risk factor is much lower. So all this common sense is put into common sense candlestick patterns that tell you where you have a high probability of the direction of a price trend or what the overall market trend is. And then you can apply the best way to be buying or shorting situations. So join us April 23rd, a full day trading. You'll get a lot of information that will help you in the future. That'll be it. We'll see you in the chat rooms.